My name is Ray. Welcome to another episode of Ray's Economics Clue Book. Today, going on our economics unit, we're talking about monetary creation and fractional reserve banking and how that works. So we already talked about money multiplier in previous videos. So how does that work through a banking lens? So let's say you're in the bank. There's a deposit of $100, and with this $100, you have something called required reserves, which are reserves usually dictated by the Federal Reserve of how much of that deposit you need to keep as reserves within your own banking system in a vault, or perhaps to the Federal Reserve account. And then other 90% are excess reserves. You can choose wherever you want. The bank can choose whatever they want to do with it. They can loan it out, which is what they usually do, or they can keep it and as excess reserves, as extra insurance perhaps, or they could use and go out on their own personal financial ventures or investments with the excess reserves. And so let's say your excess reserve requirement by the Federal Reserve is 10%. So out of the $100, you have 10% being kept as required reserves, or 9% as excess reserves, and most likely they'll be loaned out as $90. Now, in this $9 they're loaned out, or perhaps they're also kept as extra reserve, but the bank purchase assets such as real estate with these extra reserves, which creates essentially a similar effect, in which $9 goes to someone or is loaned out to someone, and then that said person spends and then 10% goes back to the reserve system, and then our $81 is loaned back out to the bank, assuming that all goes back to the bank. And if the money keeps going back towards the bank, then the same concept happens where 10% is kept reserved, the other 9% is kept as extra reserves and either used to purchase assets or used as savings. And so we have this cycle of money creation where we have $100 and then we have $90, $81, 81 times 0.9, etc. And so from this we can see that basically this is the banking perspective of the money multiplier, of the geometric sequence of money multiplier, of how we talked about previously, how money is spent throughout an economy and it keeps being spent. That's because it keeps all the money, assuming theoretically it keeps going back towards the bank. Then all the money goes back towards all the money that's spent goes back or saved goes back towards the bank, which is then kept as excess reserves or loaned back out. And then as it's loaned back out, it creates a new money flow, and then the money multiplier keeps going on through the banks. So let's look at this from a more top-down perspective. So money creation and how fractional banking works basically. So what happens is obviously the head of basically the top bank in the United States is the Federal Reserve, our central bank. Our central bank basically extends loans and regulates our large commercial banks, which are our monetary center banks. These large commercial banks, such as J.P. Chase, Citibank, etc. They have to keep a required fraction of the loan from the central bank as a required reserve. Obviously, this is a basic regulatory policy. However, the central commercial bank usually does not directly loan towards everyday consumers, such as you and me, perhaps. They first loan to other smaller, perhaps more regional, perhaps banks. These smaller banks receive funds from the monetary center banks, such as J.P. Chase. And they then keep another required reserve out of that loan, and then loan the rest out, or keep the rest as excess reserves. And excess reserves that then they either loan out, and the loan money goes into the monetary supply, and then it keeps going from bank to bank, theoretically speaking, through a monetary multiplier. Or they can go on other ventures, and these financial ventures, the spending basically goes back. The money basically from the receiver of the spending either gets spent or saved back to the bank. So everything goes back to the bank again into a required reserve ratio. And so because the loan counts as money because the loan goes to the monetary supply. Now let's talk about an interesting case from the smaller other banks. The smaller other banks, let's say the bank, let's say someone withdraws a lot of money from the bank. Let's say they'll withdraw $100 from the bank. Now the $100, 10% comes from the required reserves, other 9%, let's say, comes from required reserves. And so basically out of this $9, how's the bank going to pay back those $9 from the excess reserves? The excess reserves from this $100, which is $90, basically it comes back through the bank calling back loans. As they call back loans, $9. Let's say they call back a loan call back $9 in a loan. This $9 now and the subsequent chain reactions in the economy that would have created is now eliminated from the money supply. So basically, withdrawal basically cancels out affects the money supply created by bank loans, but through the amount of excess reserve that's withdrawn out from that withdrawal. And so from that, we can see basically the multiple directions that money multiplier can take. It can go as money goes through a bank. It keeps getting multiplied out theoretically, since all the money theoretically in this case goes into a bank. And then as it's withdrawn, that money multiplier is cancelled out through the withdrawal and the excess reserves that are taken out through that withdrawal. So that would be part 1 of our video today. Part 2, we go on to more equations detailing this process. Thank you. See you next time.